So we studied about the main definitions in the share market, like what is the share market, what are shares, and other few definitions which are needed for us. Now let's study about the different kinds of people who are present in share market. So there are different types of people. In every field, you might have seen different types of people. They do different types of jobs, right? Like that, even in the share market, we have different types of participants. They do different types of work. Like you can study this course and do different kinds of things in the share market. So what are those different kinds of things? I will tell you now. So there are people known as traders, there are investors, there are hedgers, and there is something called as arbitrager. So now what are these four terms? These four terms might seem very new to you. What is a trader? What is an investor? What is an arbitrager? What is an hedger? So trader, first let's start with the investor. Investor is the most common term that generally when we think about the share market, like big investors like Warren Buffett or other people who invest in the share market, they are actually investors. So the work of the investor is to invest large amount of money into shares as saving, because saving money, the best option to save money is share market. As I told you, it gives you high returns, and if you trust a company, if a company is going to perform well, if a company is good, your money will get increased. So you can save your money for long term. Like if you don't require money for a long period of time, say 5 years, 6 years, you want to save your money for 5 to 6 years, then investing is the best option. That is called an investor. When you save your money for a large amount of time, for a long period of time, you are called an investor. So if you have money and if you invest that money and don't touch the money for 3 to 4 years, you will become an investor. Now the next type of person are the traders. What is trader? Trader means a person whose work is to just take money from the stock market, to earn money and not to invest in a company. They are not worried about how a company is, whether the company is going to perform well or not, whether the company will go down or not. Their work is just to get profit from the company for the day and close the trade and take the profit, just to earn money on daily basis. They are called traders. They don't invest for large period of time. They just come to the share market today, they open their phones at the opening hours and start buy the trades and track the movements of the companies. When the company goes high, they sell the trades, they buy it at a lower price and sell it at a higher price. Every day they do it as a job, as a work. Every day they take profits from the stock market. They are not worried about whether the company is very good. They're not worried about the company performing 5 years from today. They don't have to save money. They just want to earn money on daily basis. So they're called traders. Like for example, I will give you an example. There are companies which are volatile. Volatile means the company moves very highly. In a day, the company makes higher movements, like 2 rupees, 3 rupees, 5 rupees, up to 5 to 10 rupees also. There are companies which move. So today the stock market had opened and in 5 minutes the company had moved for 5 rupees. The price of the share increased to 5 rupees today in 5 minutes. So what these people do, they study about the graphs, how the graph moves. The work of traders is they have the knowledge of the graphs. That is called technical analysis. There are different types of analysis, studies in share market. Studies for long term, studies for short term, how a share is going to perform. So the trader's work is to study the technical part of the technical terms, like technical analysis. They study how the graph moves. So they buy the shares at 5 rupees cheaper price and sell it when the price increases to almost 5 rupees. So they buy shares in large quantities. They buy some 100 shares. For example, if the share price moves by 5 rupees and you buy 100 shares, you have gained a profit of 500 rupees. So in a day, you earn 500 rupees just by working for 5 to 10 minutes. So this is the work of traders. They are called trader. Trader earns the profit every day. He comes to the share market to earn the profit and goes away after he makes the profit. And investors are people who have trust in a company and want to save their money in the company through the company shares. They are called investors. Like if I believe that Reliance or Tata Motors or any company is going to perform well for a large period of time, I will leave my money and I will forget it. So traders' work is every day. Every day they come to the market, every day they do the work, they earn everyday profits and go away. And investors' work is just to invest the money and forget it. They leave the money for larger period of time. They don't think about the money. Next we have someone called as hedger. Hedger are the people who have their positions, who have shares, and they buy positions to save the share. The share price might go down. There are companies which might perform low. So the hedgers buy the shares of the company for cheaper price for the future. They buy future. So you will learn these advanced things in the future course. But basically, hedgers' work is to protect their shares. That's all they do. They protect their amount. So hedging means to save from losses. You're protecting yourself from the losses. Next, we have the swing trading also. There are few people who do swing trading. Swing trading means the people who buy shares for 5 to 10 days, not like intraday trader who just do it in a single day. Swing trading people buy the shares for more number of days, and investors buy it for even more larger amount of time. Next we have mm, arbitrager. As I told you, arbitrager is another type of participant. Arbitrager work. What the arbitrager does is, there are two stock markets. As I told you, there are two stock exchanges in India, NSE and BSE. So sometimes what happens, share price differs in both. Sometimes a share might be available for cheap in the NSE and it can be costlier in the BSE. There may be 1 or 2 rupees difference sometimes, because again the share prices are based on demand and supply. Maybe in the NSE if the demand is more and in the BSE it is less, so there might be a gap in NSE and BSE. So what this arbitragers do, they buy the shares from NSE and sell it in the BSE, or they buy the shares from the BSE and sell it in NSE. So that is called as arbitraging. So that is another way of earning money. So we studied about 4 ways, 4 types of participants. That is investor, the person who invests the money for a longer period of time. Then we studied about trader, who earns everyday money from the share market. Then we studied about the hedging. Hedger means the person who protects his shares by using methods called as hedging. And fourth, we studied about arbitrager. Arbitrager is the one who makes use of the difference in the prices in NSE and BSE. Psychology of profit booking. Let's study about psychology of profit booking. So how the traders or investors, how the people who are investing in share market think, because psychology is very much important. And why do people lose money in share market? That is one of the most important question. So in case you are doing intraday trading, or even if you are an investor, you want to become an investor, why do people lose money? Because we have seen only few percentage of people actually earn money from share market. Many people lose. That's why we all are scared of share market, right? We get scared of the word share market because we have seen a lot of people losing money. So why do we lose money? So the main reason for losing the money is when we buy the shares for higher price, thinking that the shares will go high. If the company is performing very well, we might think that this company will perform. Sorry, if the company is going down, if the company is performing badly, we feel that the company will reverse. That is the mindset of most of the people, the mistake that people do. If a company is going in loss, generally we think that maybe this company will reverse today. Maybe the company will go opposite direction. We feel like that. Most of the people feel like that. If the company is going down, we feel that suddenly the company may go up, so I will buy the share. That is the mistake that people do, because the graphs, that is why you need to have the knowledge of technical analysis and fundamental analysis. So if the graph is going in downward direction, it doesn't mean that it will reverse. There are companies which keep falling and make you lose the money. And otherwise what people do, they hold their profits for larger period of time, or they sell their profits actually. People actually sell the profits very soon and they hold their losses. That is the issue with people. When the people are in loss, if I have bought a share of a company and I am in loss, what I think that one day it will give me profit. So I keep holding the share. That is why I lose more money. I lose more money because I hold my loss. I don't sell it. I think that tomorrow it will perform well. But that is a mistake. Because if I am in a loss, that doesn't mean that the company will perform well one day. That because it is based on technical and fundamental analysis. So you shouldn't hold a share if it is going down. And you shouldn't sell your profits very soon. That is another mistake. If a company is performing well, we get scared. If the share price increases by 5 rupees, we think that it will fall. We think that the share price will go away from 5 rupees. I might lose the money and we sell very quickly. We don't hold it. That is another mistake. So if a company is performing well, you should have your target and sell it only after achieving the target. You shouldn't sell it very quickly. So that is the main mistakes that the traders do. Psychology of the traders. Now let's study about how you can earn from intraday trading. How intraday traders actually make money. So as I told you, intraday traders are the people who track the company shares in a single day. Every day they buy shares of many companies and earn profits. They buy in larger quantity and sell in larger quantity and get the profit. So they make profit by few rupees movement. By the volatility of the market, they earn the profit. So now most of you might think that what if I lose my money? That is the question. Most people have the question that what if I lose my money in the share market? So that is the main thing we should think about. So losses are limited, but profits are unlimited in the share market. So this is very easy to understand, because in stock market you have something called as stop loss. Now what is stop loss? Stop loss means you can keep a stop loss. Stop loss is an amount at which your share will automatically get sold. When the share price hits that amount, the least amount that you decide. You fix a price. When the share touches that price, your shares will get sold. So you will not lose more money. That is called as a stop loss. So imagine I bought a company share for 200 rupees and I don't want to lose my money. I'm ready to lose only 10 rupees. I don't want to lose more than 10 rupees. So I can keep a stop loss at 190. I bought the share for 200. I can keep the stop loss at 190 if I'm doing intraday trading. If I feel that the company share will not go below 190 and I'm ready to lose 10 rupees, then I have to keep my stop loss at 190. As soon as the share price touches 190, my share will get sold. So this is called as stop loss. Stop loss is the amount below which if the share goes, your share will be sold and you will not get loss. You will not lose money more than the money you fix. So this is the reason why you can restrict your losses. You will not lose full money in the share market because you can fix a limited amount of money to lose. But the profits are unlimited because the share can go as high as it wants. The share can increase in price very much and you can make use of this moment to get the profit and then sell the shares. So that is why you should have the knowledge. You should know how to buy and sell the shares and when to buy and when to sell the shares. So this is called stop loss. That is a very important word, stop loss. Stopping your loss at an amount which you decide. So as soon as you enter the share market, you should enter, when you do intraday trading, you should enter intraday trading with the maximum amount that you can lose. You should have fixed in your mind that the amount I'm going to lose today is 10 rupees and I'm not ready to lose more than 10 rupees in a share. So you can fix the stop loss to 10 rupees. So that is how you must invest in intraday trading. Now that is the importance of stop loss actually. The importance of stop loss is you will not lose your money more than the money you fix, you decide. So it helps you prevent losses. Now let's study about the indices. Most of us might have heard the term indices. What is index actually? Index means Nifty, Sensex. We might have heard these words like Nifty 50, Nifty 100 and Sensex. These Nifty, different types of terms are there. So what is this Nifty first of all and what is the Sensex? So Sensex means sensitivity index. The full form of the meaning of Sensex is sensitivity index. It tells the sensitivity of the market. So there are many shares in the stock market, right? You might have seen there are shares of Reliance, there are shares of Tata Motors, there are many companies, there are thousands of companies in the share market. But how will I know whether the overall market condition, how is the market performing today? All the companies are doing well or low? How will I know? What is the condition of the market in average? So to measure that, we have this index, just like your speedometer in your bike, or just like the other index, your marks card, progress card, which tells the condition of your average. You have the average marks, right, which tells you the grading of all the subjects. In 6 subjects, what is the average condition, how you are performing. So the performance of the stock market is told by the index. So the Nifty 50 and Sensex. Sensex means sensitivity index. It shows the sensitivity of the market, how the market is moving, whether it is performing good, bad. The movement of the overall market is shown by Sensex. And Nifty. Nifty means National 50. National 50. So Nifty means it is the combination of 50 stocks. It is a combination of 50 stocks which are the best top 50 stocks. So Nifty tells us the condition of the top 50 stocks, whether the top 50 stocks are performing good or bad. So there are a few companies in Nifty. Nifty is a list of 50 companies. There are 50 companies in Nifty. And average of all the 50 companies, how the 50 companies are performing is called Nifty. So the combination of all the 50 companies in few percentage, there are percentages assigned for every company. So if that company performs well, the Nifty price will go high. If all the 50 companies in Nifty perform low, it goes low. So that is what is called as Nifty. It tells us the condition of the market. Now you must know another term which is called FII. FII are foreign institutional investors. FII means foreign institutional investor. They are the foreign people, the people from other countries who invest their money in our Indian share market, because there are foreign people who might be interested in our Indian shares. So they are the foreign big institutions. There are big institutions who invest money in other countries. So the foreign institutional investors buy large amount of shares. They trade in very huge quantities of shares in the Indian share market. So they affect the share prices very highly because they have large amount of shares. So they also affect the share market. The price of the shares depends on them too. So that is FII. FII are the foreign institutional investors who invest money in the Indian share market. So that's all for today. Thank you.